Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Scansource Inc. quarterly report. Scansource Inc. offers a wide range of technology products and solutions through its two main segments, Specialty Technology Solutions and Intellices and Advisory. The company's Specialty Technology Solutions segment provides various business services, including mobility and barcode solutions, point-of-sale systems, physical security, networking, communications, managed connectivity, and wireless enablement solutions. These applications cater to traditional uses such as inventory control, materials handling, distribution, shipping, and warehouse management, as well as healthcare applications. In addition, Scansource's Intellices and Advisory segment offers advanced services like connectivity and software-defined networking, unified communications as a service and contact center as a service, cloud/data center solutions, security, managed AI, and wireless and IoT. This segment helps channel sales partners serve various industries, including manufacturing, retail, hospitality, transportation, government, education, healthcare, and more. Overall, Scansource's diverse range of products and services enables businesses to streamline their operations, enhance customer experiences, and stay ahead in the competitive market. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what might cause a company's stock price to remain stagnant over a period of time. The stability of Scansource Inc.'s stock price in the past year may be attributed to several factors. One possible reason is that the company has been maintaining its market share and revenue growth at a steady pace, without any significant disruptions or changes in its business operations. This consistency can lead to a stable stock price as investors become accustomed to the company's performance. Another factor could be the lack of major news or events affecting the company's industry or sector. If there are no significant developments or announcements that impact Scansource Inc.'s market, it may not have a substantial effect on its stock price. Additionally, the overall market conditions and economic trends can also play a role in determining the stability of a company's stock price. Furthermore, Scansource Inc.'s financial performance and management team's strategies might be contributing to the stable stock price. If the company is generating consistent profits, managing its debt effectively, and making smart investments, it may not have a significant impact on its stock price. The absence of any major scandals or controversies surrounding the company can also contribute to its stable stock price. In conclusion, Scansource Inc.'s stable stock price in the past year could be due to a combination of factors such as consistent business operations, lack of industry disruptions, and strong financial performance. Scansource Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. Scansource Inc. trades at a lower price-to-earnings ratio of 12 times and a lower price-to-book ratio of 0.91 times relative within the industry. This suggests a potential market detachment, as Scansource Inc. trades at discounted levels while the broader industry remains fairly valued, warranting deeper fundamental analysis. The company maintains a moderate leverage profile, with liabilities making up 49% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline can be identified in the extracted summaries. On one hand, revenue growth is driven by several factors. In Specialty Technology Solutions, net sales growth rates have been positive, with a 2.5% increase in Q4 and a -1.3% decrease in $6 million. Additionally, higher sales volumes, favorable supplier recognition programs, and unfavorable freight costs have contributed to revenue growth. Intellices and Advisory has also seen growth, with a net sales growth rate of 3.1% in Q4 and 1.9% in $6 million, primarily due to increased sales volume from Intellices. Recurring revenue has also experienced significant growth, increasing by $23,870 or 56.3%. On the other hand, revenue decline is attributed to several factors. Net sales have declined by $16,915 over 6 months, with a minus 0.7% decrease in United States sales and a minus 5.9% decrease in Brazil sales. Other neutral/other factors that may impact revenue include acquisitions, tariffs and trade policies, macroeconomic environment, supplier price increases, and channel sales partner demand. These factors can have both positive and negative impacts on revenue growth or decline. The net income of a company underwent fluctuations between 2024 and 2025. Initially, it decreased by 3.6% from $17,053,000 in 2024 to $16,493,000 in 2025. However, this decrease was followed by an increase of 7.1% from $34,028,000 in 2024 to $36,372,000 in 2025. Furthermore, for the quarter ended December 31, 2025, net income decreased by $576,000, minus 3.1%, while it increased by $7.7 million, 21.3%, for the 6 months ended December 31, 2025. Profit margins also experienced changes during this period. The gross profit margin decreased from 13.6% in 2024 to 13.4% in 2025, but then increased to 14% in 2025. Similarly, the operating income margin decreased from 2.48% in 2024 to 2.35% in 2025, but later increased to 2.9% in 2025. Segment profit margins also showed variations. The Specialty Technology Solutions segment's gross profit margin decreased by 20 basis points to 10.5% for the quarter ended December 31, 2025, but it increased by 54 basis points to 11.1% for the 6 months ended December 31, 2025. In contrast, the Intellices and Advisory segment's gross profit margin decreased by 8 basis points to 98.8% for the quarter ended December 31, 2025, and further decreased by 108 basis points to 98.1% for the 6 months ended December 31, 2025. The fluctuations in net income and profit margins can be attributed to various factors such as changes in market conditions, operational efficiency, and strategic decisions made by the company's management. The company's financial performance indicates a significant improvement in its operating cash flow. A comparison of the 6 months ended December 31, 2025, with the same period in 2024 reveals a substantial increase from $38,642 to $54,052. This upward trend is further reinforced by the fact that both years' operating cash flows are stated as positive on page 52. The data suggests that the company is successfully generating sufficient cash from its operations to support its financial obligations and growth initiatives. The company's debt level has undergone significant changes over the past year. Initially, total liabilities decreased by $48,412 from $879,197 to $830,785. However, long-term debt increased substantially from $0 in 2024 to $100,000 in 2025. Furthermore, the average daily outstanding balance on revolving credit facility rose from $0.3 million to $1.7 million. Additionally, the company's total debt decreased from $136,149 million at June 30, 2025 to $102,663 million at December 31, 2025. The overall trend indicates a slight increase in debt level. In terms of interest expenses, there has been a notable decrease over the past year. Interest expense decreased by $24 quarter-over-quarter and $132,000 year-over-year. Specifically, for the quarter ended December 31, 2025, interest expenses were minus $260,000 compared to minus $391,000 in the same period of 2024. For the 6 months ended December 31, 2025, interest expenses decreased from minus $900,000 to minus $581,000. The company's interest expense also decreased by $24,000, 1.2%, in Q4 2025 and $219,000, 5.4%, in 6 months ended December 31, 2025. Management is optimistic about the company's outlook, citing its unique position in addressing complex technologies and accelerating growth for channel sales partners. The company continues to evaluate acquisitions and actively monitors changes in the global macroeconomic environment. To mitigate risks, management is implementing strategic planning and maintaining financial flexibility. In terms of financial projections, Scansource expects an effective tax rate of 27.2% to 28.2% for fiscal year 2026. The company's cash flow and capital expenditures are also expected to remain stable, with net cash provided by operating activities projected to increase from $38.6 million in 2024 to a range of $54.1 million to $64.7 million in 2025. Management is confident in the company's liquidity, stating that it has sufficient funds to meet present and future needs, supplemented by credit agreements. The company expects to pass through supplier price increases resulting from tariffs to channel sales partners, but is taking steps to mitigate related risks through strategic planning and financial flexibility. The company has made several strategic moves through acquisitions and divestitures to enhance its operations and financial stability. In terms of acquisitions, the company has expanded its capabilities by purchasing equipment for a warehouse in South Haven, Mississippi. Additionally, it has acquired Ressourcive, Networkone, Advantix, and DataZoom, which are expected to bring new technologies and services to the table. These acquisitions demonstrate the company's commitment to growth and innovation. On the other hand, the company has also engaged in divestitures to streamline its operations and reduce debt. Specifically, it has terminated all indebtedness with J.P. Morgan Chase Bank, N.A., effectively eliminating a significant financial burden. This move is expected to improve the company's financial flexibility and stability going forward. The company has engaged in share buyback activities to reduce its outstanding common stock. As per the financial records, the company repurchased common stock in September and December 2025, indicating a deliberate effort to decrease its equity base. The total amount spent on share buybacks for both 2024 and 2025 is substantial, with $38,687 and $52,342 respectively. This significant use of cash highlights the company's focus on reducing its outstanding shares rather than distributing dividends to shareholders. The data provided in pages 57 and 53 further supports this conclusion, showing a notable increase in share buybacks over the past 2 years. In summary, the company has opted for share buyback as a means to manage its capital structure, choosing not to distribute dividends to its investors. The company's financial reports reveal a notable increase in inventories at the end of 2025. Specifically, there was an increase of $519 million in inventories by December 31, 2025. This suggests that the company may be holding onto more stock than necessary, which could indicate potential issues with inventory buildup. Furthermore, the inventory turnover rate for the quarter ended December 31, 2025, was 5.3 times, a slight improvement from the prior year quarter, but still lower than the quarter ended June 30, 2025. This slower turnover rate may be a sign of supply chain disruption or inefficiencies in the company's logistics and distribution processes. That concludes the financial summary for Scansource Inc. Feel free to comment below, and I will be happy to answer them when possible.